Let me share something that I've learned from sitting across the table from South Africans with real wealth. 10, 20, or sometimes 50 million rand portfolios. They don't mind paying tax when it's fair, but they absolutely hate overpaying tax when there's a perfectly legal way to reduce it. And one of the biggest quiet opportunities in South Africa is this. There's an account where SARS cannot touch your growth, not your interest, not your dividends, not your capital gains, and not when you withdraw. Here's the thing, most people assume that must be some complicated offshore structure, a crypto scheme, or a clever shortcut. But it's not. It's a tax-free savings account. And used properly, it can become one of the most powerful building blocks in your retirement plan. But here's the problem. Most South Africans are using it like a bank account. They leave it in cash, they withdraw too early, or they pay unnecessary fees and high costs. And then they say, tax-free savings account don't really make a difference. They absolutely do, if you use them correctly. Some South Africans are going to retire as millionaires, completely tax-free, and many others are going to miss this opportunity simply because they never understood how to use it. It's a simple investment account that anyone with a South African ID can open, but you need to use it in the right way. Today, we are going to show you exactly how TFSAs really works, the family wealth TFSA strategy that we use to help our clients retire with millions more tax-free, and the biggest mistakes to avoid and most common questions we regularly receive. And at the end of this video, we'll show you exactly how it fits inside a proper South African retirement plan. If we haven't met before, my name is Hardi, Swart, certified financial planner and founding member of Family Wealth Custodians. Today I'm joined by senior financial planner and my colleague Cam Sondlo. We focus on helping South Africans retire with clarity and confidence and control, particularly those approaching or already in retirement. This video forms part of our retirement tax planning series, where we break down the tax strategies and vehicles that can make a meaningful difference in retirement outcomes. As always, this video is for educational purposes only, and it doesn't constitute personal financial advice. Please consult with a certified financial planner or a relevant professional before making any big decisions. So Cam, one of the most frequent questions we get is, what is a tax-free savings account?
So a tax-free savings account is a special investment account available to any South African individual or tax resident. Inside this account, there's no income tax on interest, no dividends tax on local dividends, and no capital gains tax, and no tax when you withdraw. So growth inside the TFSA is completely tax-free. Hardly zero, nothing, nix. Now here's an important update many people have missed. For years, the annual contribution limit was 36,000 Rand. But from 1 March 2026, that has now increased to 46,000 per tax year. But your lifetime contribution limit is still 500,000. That's important. And this matters because the 500,000 is only your contribution limit, not your growth limit. Once you've contributed the 500,000 over time, the growth above it can compound for decades and decades completely tax-free. So if your tax-free grows to 2 million or 5 million, even more, SARS does not share in that growth. Again, zero. That's why it's so powerful when structured properly.
Next, we're going to explore the 3-step family wealth tax-free savings strategy. First of all, we're going to look at maxing it out early. Time is your biggest asset. The sooner you reach your 500,000 lifetime limit, the longer your money compounds tax-free. And because that annual limit is now 46,000 Rand, you can reach that lifetime cap so much faster. The earlier you reach it, the more time you have, the more time your portfolio has to grow. Compounding doesn't reward intelligence, it rewards time. It might sound insignificant, but 5 years earlier can make a multi-million rand difference over a 30 or 40-year time horizon.
Point number 2, don't just save it or treat it like a piggy bank. Invest it. This is the biggest mistake we see, Hardi. It's called a tax-free savings account, but for retirement planning, it should be treated like a tax-free investment account. If you leave it sitting in cash earning 5 to 6% or even less, you're limiting its long-term power. Take George, for example. He's a 55-year-old South African and part of the executive team at a large listed company. He had a tax-free savings account for a while, but he didn't know that he could actually invest the money inside the account. His TFSA was sitting in cash. After doing a retirement master plan, he realized that inside the TFSA, he can invest in broad global ETFs, in low-cost diversified balanced portfolios, or also exposure within the regulations. These simple changes could easily add millions to his portfolio over time, not because of his larger salary, but because he's letting his existing money do the work for him. Yes, markets fluctuate, but over decades, growth assets have historically outperformed cash. So the difference between 5% and 12%, which is the average price return of the JSE All-Share Index over 25 years, is enormous. That's the difference between a nice bonus and a serious retirement asset.
Now we get to point number 3. Leave it alone. Don't touch it. Your tax-free savings account should be the first account you max out, but the last account you withdraw from. Because once you withdraw from it, you don't get that tax contribution space back. Here's the thing. If you've contributed, let's say, 300,000 Rand to a tax-free savings account and withdraw 50,000 Rand, your lifetime cap remains 500,000 Rand. So that 50,000 Rand that you just withdrew is now gone. The space is permanently gone, actually. This is not your emergency fund. It's a long-term, tax-free capital vehicle.
So some of the biggest mistakes we often see with our clients. 1, over-contributing. If you contribute more than 46,000 in a tax year, SARS charges a 40% penalty on the excess. You can have multiple TFSAs, but your total contributions across all providers combined must stay below 46,000 per year. You can't cheat that. Paying high fees, which we've seen with multiple clients as well. So fees compound negatively. Over 30 or 40 years, 1% extra in fees can reduce your final value by 20% or more. 2% extra can reduce it by more than 35%. It's not just the fee, it's the growth you lose on that fee. Keep it efficient, keep it simple. And then there's using it for short-term goals, which we also often see. Again, this is not your holiday account. It's not your car fund. It's not your school fees account. If you treat it casually, you destroy the long-term compounding power.
All right, Cam, so let's look at a couple of common questions that we oftentimes get from our clients.
Yeah, so can I open one for my child?
You definitely can, but remember that 500,000 lifetime limit belongs to them. So if they use it, or if you use it for short-term spending, that permanently removes decades of tax-free growth for their future.
Another question is, can I transfer between different providers?
Again, you can, but it must be a formal transfer. I think the biggest mistake that we see from clients is they withdraw their tax-free savings account thinking that they can just recontribute.
Yeah.
But remember, you cannot, because you'll lose your lifetime sort of cap. So never withdraw and redeposit a withdrawal, because a withdrawal can permanently use up your contribution space.
Then next question, is 46,000 per year enough for retirement?
Well, that depends, but most probably not, especially not for high-income earners. So a tax-free savings account is a strategic part of your retirement portfolio. It gives you the opportunity to invest in a structure where you see tax-free growth until retirement. And when you then draw from that portfolio, like we said, the income you draw is absolutely tax-free. So again, retirement planning is not one big thing. It's a combination of small little things over time, especially when it comes to tax, that can have a massive impact on your long-term outcomes.
So for many of our clients, the TFSA becomes a tax-free growth engine. It becomes a late retirement income buffer and a discretionary spending account, or even a legacy asset for children. In retirement planning, flexibility equals control, and tax-free capital gives you flexibility. Now, here's what that looks like in real life. When markets are down, you can avoid selling growth assets at the wrong time because you've got a tax-free pocket of money you can draw from strategically. When SARS changes rules or tax rates increase, having a portion of your wealth already sitting in a tax-free structure gives you more options. When you need a lump sum in retirement for travel, medical expenses, or helping out a child, or a home upgrade, drawing from a TFSA can be cleaner than triggering capital gains in a discretionary account. So we don't look at a TFSA as a small side account. No, we treat it as a strategic piece of the retirement puzzle, a tax-free reserve that gives you more control over how, when, and from where you draw your income in retirement.
All right, so here's a quick recap. So if you remember nothing from today's conversation, please just remember the following. First of all, you can contribute up to 46,000 Rand per year to your tax-free savings account. But it's super important to not exceed this annual contribution because you'll be heavily penalized.
Secondly, reach the 500,000 lifetime cap as early as possible.
Next, it's super important to remember although it's called a tax-free savings account, it's more like a tax-free investment account. So focus on long-term growth inside this vehicle because it could be highly efficient.
And lastly, leave it alone. Used correctly, your TFSA can quietly become one of the most powerful wealth building tools available in South Africa. And SARS will never touch the growth.
If you're serious about building a structured retirement plan in South Africa and you need help with your own retirement master plan or to see how a tax-free savings account fits into your plan, then you can schedule a complimentary exploration call with one of our retirement professionals. The link is in the description below.
Let us ask you, are you currently investing in your TFSA for growth or is it sitting in cash? Comment below. We read every comment.
If this video helped you understand the real power of a tax-free savings account, please like the video and subscribe to the Family Wealth YouTube channel and share the video with someone who needs to see this. We'll see you in the next video. My name is Hardi Swart.
I'm Sondlo.
This is Family Wealth. Keep investing into your future.